This week, home loan rates ticked higher in a week filled with some negative surprises. Let's discuss what happened and take a look at the week ahead. Just another 1 trillion, please. Earlier in the week, the Treasury Department surprised the financial markets when they stated they need $1 trillion to fund the government from August to October. The problem, it was $275 billion more than what was expected just a few months ago when the Treasury last released their funding expectations. How does the Treasury Department raise the $1 trillion? By selling Treasury bills, notes, and bonds at auction. The bond market hated the announcement and pushed rates higher in anticipation of even more bonds that must get sopped up at weekly Treasury auctions. U.S. debt downgraded. The bond market was not the only thing that didn't like the Treasury Department's call for more money. Fitch Ratings downgraded U.S. debt one notch from AAA to AA+. They cited fiscal deterioration over the next 3 years as the driver behind the decision. Our debt was downgraded back in 2011 for many of the same reasons, which were rising debt, political division, etc. But this time, things are slightly different. Back in 2011, we had just $6 trillion in government debt, and today we have over $32 trillion in debt. We do have some history on our side. Back in 2011, after the debt was downgraded, interest rates did improve in the months following. For the interest rate sensitive housing sector, this would be a welcome development. Japan seen higher rates. The Bank of Japan has started to loosen their yield curve control policy by allowing their 10-year government bond to float from a cap of 0.5% to 1%. This is a big change from a government that had pinned rates at just 0% for years. As the Japanese interest rates crept higher upon the announcement, it placed upward pressure on our rates as well. 4.09%. On Thursday, the 10-year note was right at an important level of 4.09%, which has been serving as yield resistance, preventing rates from moving higher since November. If the 10-year moves above this level, we could easily see home loan rates move another leg higher still. Bottom line, the financial markets were unnerved by the double whammy of surprises with the Treasury's request for more money and the subsequent debt downgrade. Time will tell whether rates can reverse from key levels like it had since November, or will we see yet another leg higher in rates? Now, looking ahead, this week we'll deliver one of 5 key reports the Federal Reserve said to watch prior to the next Fed meeting in September, the Consumer Price Index, or CPI. Last month, the June reading came in at 3%, which was well off the June 22 reading of 9%. If the reading comes in higher than expected, rates could move higher, and the opposite is true. Thanks, everyone, for hanging with me for this week's market update. I'm always here to help, and I look forward to funding your future. Enjoy the rest of the week.